California's housing market is teetering on the edge, and in 2025, the crash is no longer a whisper, it's a scream. Across the Golden State, once booming cities are now flooded with listings, gutted by massive price cuts and haunted by vanishing buyers. Home values in some areas have already plunged by over $200,000, with mortgage payments topping $10,000 a month. Investors are fleeing, sellers are panicking, and inventory is exploding. This isn't just a cooling, this is a full-blown correction. From luxury enclaves to tech capitals, these 10 California cities are leading the collapse. Number 10. Stockton. Stockton, a Central Valley city with a population of around 322,000, is quietly becoming one of California's most vulnerable housing markets in 2025. After experiencing a wild ride during the 2008 housing crash, where prices dropped by over 55%, Stockton rebounded sharply in the 2020s due to pandemic-era migration and record-low mortgage rates. Between 2020 and 2022, median home prices in Stockton jumped from approximately $350,000 to nearly $495,000, a staggering 41% increase in just 2 years. But now, the cracks are beginning to show. As of mid-2025, the median home price in Stockton has declined to around $450,000, shedding roughly $45,000 from its peak, a nearly 9% drop. While that might not seem catastrophic yet, it's a worrying sign in a market known for volatility. Inventory has increased by over 40% year over year, and the average days on market has jumped from 22 days in early 2023 to over 45 days in 2025, are increasingly slashing prices, with over 32% of listings seeing reductions, one of the highest rates in the state. What's driving this downturn? A combination of high mortgage rates, hovering around 7.1%, inflationary pressure, and stagnant wages in a region heavily reliant on logistics and agriculture. Stockton's unemployment rate remains above the state average at 6.3%, and its household median income at about $68,000 is struggling to support rising costs of ownership. With monthly mortgage payments now averaging $3,250 for new buyers, even with 20% down, the affordability index has dropped sharply. Investors who once flocked to Stockton for cheap flips are now retreating, with investor purchases down 35% since 2022. Vacancy rates are rising, rental yields are shrinking, and many are choosing to wait or sell at a loss. If interest rates stay elevated and economic growth slows, Stockton could be one of California's early warning signs of a broader housing correction. Number 9. Costa Mesa. Costa Mesa, nestled in the heart of Orange County with a population of roughly 111,000, is one of California's trendiest yet most overpriced housing markets, and it's now facing serious correction pressure. Home prices surged dramatically between 2019 and 2022, jumping from around $750,000 to a peak of $1.2 million, marking a 60% spike. This sharp increase was fueled by pandemic-era demand, limited inventory, and proximity to coastal hubs like Newport Beach. However, in 2025, the tide is turning. As of mid-2025, the median home price in Costa Mesa has dipped to approximately $1.07 million, a decline of nearly $130,000 or 11% from its peak. The city's affordability crisis is hitting a wall. With 30-year mortgage rates hovering around 7.1%, monthly payments on a median-priced home now exceed $6,900, even with 20% down. That pushes the average household, which earns around $108,000 annually, way beyond a sustainable debt-to-income ratio. Price cuts are sweeping through the market. Over 29% of listings have reduced asking prices, and inventory is up 47% year over year. Homes that once sold in under 2 weeks now sit on the market for over 40 days. Investor activity has also cooled significantly, with investor-backed purchases down by 38% compared to 2022. Costa Mesa's appeal, trendy shopping at South Coast Plaza, artsy neighborhoods, and a coastal lifestyle is undeniable, but buyers are pushing back. Many millennials priced out or burdened by student debt are postponing purchases. Even high-income earners are looking inland or out of state for better deals. Without a major interest rate drop or a significant income spike, Costa Mesa's inflated home values will continue to face downward pressure. For now, it's becoming a high-risk zone for those banking on short-term appreciation. Number 8. Tustin. Tustin, located in central Orange County with a population of about 80,000, is experiencing serious housing market turbulence in 2025. Once a suburban refuge with relatively affordable homes, Tustin saw its property values explode during the 2020 to 2022 boom. Median home prices climbed from around $700,000 in early 2020 to a peak of $1.15 million by mid-2022, a 64% surge in just 2 years. But that growth came with risk, and it's now showing signs of unraveling. As of mid-2025, the median price has dropped to around $1.02 million, a roughly 11% decline from the peak. Tustin's affordability index has fallen sharply. Monthly mortgage payments on a median-priced home now exceed $6,600 with current rates over 7%. For local households earning around $105,000 per year, that's simply out of reach without dual incomes and significant cash down. Inventory has ballooned by 52% over the past year, and nearly one-third of all listings have undergone price reductions. Homes that used to spark bidding wars now linger on the market for 45 to 50 days on average. Investors who once targeted Tustin for flip and rent opportunities have largely pulled back, with investor activity dropping 36% compared to its 2021 peak. Adding to the stress, rising insurance premiums due to climate risks and aging infrastructure are squeezing buyers further. Even though Tustin remains a beautiful and well-located city with charming neighborhoods like Old Town and excellent schools, demand is cooling. Unless interest rates fall significantly or incomes surge, home prices in Tustin are likely to see further corrections in 2025. The days of ultra-fast appreciation are over, and a softer, but very real, market reset is unfolding. Number 7. Coto de Caza. Coto de Caza, an exclusive gated community in southern Orange County, has long been a symbol of luxury suburban living. With a population of just over 15,000 and a median household income of about $190,000, it's no surprise that this community saw massive home appreciation over the last decade. Median home prices soared from around $1.1 million in 2016 to nearly $2.2 million by late 2017-2022, a stunning 100% gain. But in 2025, that momentum is reversing fast. Currently, the median home price has slipped to around $1.9 million, a decline of $300,000 or nearly 14% from the peak. Homes that once sold in less than 20 days now sit on the market for 50-plus days. More than 30% of listings are seeing price cuts, and new construction in nearby areas is providing wealthy buyers with more options at better value. Coto de Caza's real estate market is particularly vulnerable because of its high price point and dependence on affluent buyers. With mortgage rates at 7%, the monthly payment on a $1.9 million home, even with 20% down, exceeds $11,000, a figure that's making even high-income earners think twice. Inventory is up by 42% year-over-year, and investor activity has dropped sharply, down over 40% since 2022. Many potential buyers are now sitting on the sidelines, hoping for steeper discounts. And with rising insurance costs for large homes in hilly, high-risk fire zones, the cost of ownership continues to climb. Coto de Caza is still a beautiful, prestigious place to live, but its price levels became detached from the broader economy. In 2025, it's facing a luxury market correction that could deepen if interest rates remain high or if economic conditions worsen further. Number 6. Villa Park. Villa Park, a small and affluent enclave in Orange County with a population of around 5,900, is often dubbed the hidden jewel due to its exclusivity and spacious estate-style homes. But in 2025, even this jewel is starting to lose its shine. The median home price in Villa Park surged from approximately $1.3 million in 2019 to a staggering $2.5 million by 2022, a 92% increase in just 3 years. That level of price inflation simply wasn't sustainable. As of mid-2025, home values in Villa Park have dipped to around $2.2 million, marking a $300,000 or 12% decline from the peak. While that may not sound massive for ultra-wealthy buyers, it signals a broader trend of softening demand in high-end luxury markets. With 30-year mortgage rates holding above 7%, a $2.2 million home now comes with a monthly mortgage payment of nearly $13,000 even with 20% down. Villa Park's real estate market is further squeezed by rising property taxes, higher insurance premiums, and reduced demand from investors and second home buyers. Inventory has increased 38% over the past year, and more than 28% of homes currently on the market have undergone price reductions. Days on market have nearly doubled, from 24 days in 2022 to over 47 in 2025. Unlike other cities, Villa Park doesn't have the draw of dense amenities or coastal views. It thrives on exclusivity, but that's also what's now working against it. With fewer buyers able or willing to pay multi-million-dollar prices, sellers are beginning to chase the market downward. If broader economic uncertainty continues or interest rates remain high, Villa Park's correction could deepen, potentially shedding another 10% by year-end. Number 5. Oakland. Oakland, located in the East Bay region across from San Francisco, is one of the few major cities in California already experiencing a clear housing market decline in 2025. With a population of over 430,000, Oakland saw its median home price soar from roughly $675,000 in 2019 to a high of $950,000 in 2022. A 41% increase driven by urban spillover, tech expansion, and remote work demand. But that momentum has flipped. As of mid-2025, Oakland's median home price has fallen to approximately $885,000, a decline of $65,000 or nearly 7%. According to recent housing data, this is one of the steepest year-over-year drops in any major California city. The market shift is being driven by surging inventory, up 45% in just 1 year, and a sharp decline in buyer competition. Listings are sitting longer, with average days on market climbing from 18 in 2022 to over 41 now. Affordability is another major hurdle. At current mortgage rates of 7.1%, monthly payments for a median-priced home in Oakland exceed $5,400. Unaffordable for many when the city's median household income is just around $86,000. Nearly 30% of current listings have seen price cuts, and bidding wars have become rare. Oakland's challenges go beyond interest rates. Rising crime concerns, persistent homelessness, and tax burdens are pushing some would-be buyers to nearby suburbs or out of state altogether. Investor interest, once a key driver, is down nearly 35% since 2022. Meanwhile, rental demand is softening, which has reduced the appeal of buy-to-rent strategies. Unless economic conditions improve or mortgage rates fall significantly, Oakland is poised to see continued downward pressure on home values in 2025, especially in mid-tier and entry-level segments. Number 4. Dana Point. Dana Point, a scenic coastal town in South Orange County with around 33,000 residents, is known for its luxury oceanfront real estate and high-end lifestyle. But in 2025, even this postcard-perfect destination isn't immune to the housing market correction. The median home price in Dana Point exploded during the pandemic, climbing from $950,000 in 2019 to over $1.75 million in 2022, a nearly 85% jump. This spike was fueled by remote work, coastal demand, and low interest rates. But now the waves are receding. As of mid-2025, the median price has dipped to around $1.54 million, a drop of roughly $210,000 or 12%. Mortgage rates above 7% have made these high-end properties harder to finance. A 20% down payment still leaves a monthly mortgage of over $9,400, an amount out of reach for most households, even in wealthy enclaves. Inventory in Dana Point has surged 50% year over year, with over 31% of active listings seeing price cuts. Homes that used to receive multiple offers in a week now linger on the market for 55-plus days. Investor activity is down more than 40% since 2021, as luxury coastal properties have become less appealing, due to slowing appreciation and higher carrying costs. Adding pressure is California's insurance crisis. Many coastal homes in Dana Point face rising premiums or even non-renewals due to wildfire and flood risks. Combined with rising property taxes and slower buyer demand, the cost of ownership is soaring even as property values fall. While Dana Point remains a dream location, its housing market in 2025 is undergoing a painful recalibration. Without a drop in rates or a resurgence in high-income migration, prices here could decline another 5 to 10% by the end of the year. Number 3. Aliso Viejo. Aliso Viejo, a master-planned community in southern Orange County with a population of around 52,000, has seen one of the most rapid run-ups in home prices over the past few years, and now it's facing one of the sharpest corrections. Between 2019 and 2022, the median home price in Aliso Viejo surged from about $680,000 to nearly $1.2 million, representing a 76% increase fueled by low interest rates and soaring demand for suburban living. But in 2025, that momentum has reversed course. As of mid-2025, the median home price has fallen to approximately $1.05 million, a loss of $150,000 or roughly 12.5% from its peak. Inventory has risen dramatically, up 53% year over year, and over 34% of active listings have already undergone price reductions. Homes that once sold in under 2 weeks are now sitting on the market for 50-plus days, signaling buyer hesitation and softening demand. With mortgage rates averaging 7.1%, a new buyer putting 20% down on a $1.05 million home faces monthly payments around $6,800, well above what the median household income in the area, about $112,000, can comfortably support. Investor activity is also drying up, down nearly 40% from its 2021 highs, as flipping and renting become less profitable in this environment. Aliso Viejo's appeal, its proximity to Laguna Beach, strong schools, and well-kept neighborhoods, is still strong, but affordability has reached a breaking point. Even high-earning professionals are being priced out or choosing to wait for deeper discounts. With rising insurance costs, increasing inventory, and a mismatch between home prices and income growth, Aliso Viejo is on track to see further price corrections through the end of 2025. A 15 to 18% total decline from peak pricing is not out of the question if rates remain elevated. Number 2. San Jose. San Jose, the unofficial capital of Silicon Valley with a population of over 970,000, has long been one of the most expensive housing markets in the country. Home prices soared during the tech boom, jumping from a median of $930,000 in 2019 to a staggering $1.58 million by mid-2022. A 70% increase driven by remote work, tech IPOs, and a red-hot investor market. But in 2025, the cracks are starting to form. As of mid-2025, the median home price in San Jose has softened to around $1.45 million, a decline of $130,000 or roughly 8.2%. While this isn't a dramatic crash, it signals the beginning of a longer-term correction. Homes are staying on the market for an average of 42 days, up from just 17 in 2022. Over 28% of listings have seen price reductions, and bidding wars have become rare. Affordability remains the core issue. Even with 20% down, monthly payments on a $1.45 million home hover around $9,400 at current rates. That's a crushing burden, even for tech workers, when the city's median household income is about $125,000. Many buyers have paused their searches entirely, waiting for more favorable conditions or moving to more affordable nearby cities like Sacramento or Modesto. Inventory has risen by over 40% compared to the previous year, and investor interest is down nearly 35% since 2022. With big tech layoffs and remote work trends shifting demand, the once bulletproof San Jose market is losing its edge. While the long-term outlook for San Jose remains solid due to its tech economy, the short-term forecast calls for further corrections. Unless interest rates fall below 6%, the city could see home values drop another 5 to 8% before stabilizing. Number 1. Irvine. Irvine, one of Southern California's most affluent and meticulously planned cities, has become the poster child for overvaluation in 2025. With a population of over 310,000 and some of the state's best public schools, clean infrastructure, and corporate hubs, Irvine attracted a flood of high-income buyers during the pandemic boom. Between 2019 and 2022, the median home price skyrocketed from $850,000 to nearly $1.6 million, an increase of nearly 88%. But now the story is shifting. As of mid-2025, the median home price in Irvine has slipped to around $1.48 million, a decline of $120,000 or about 7.5%. While not a full-blown crash, it's the start of a deeper correction. Buyer demand has cooled significantly. Inventory is up by 55% year over year, and price reductions are becoming the norm. More than 30% of listings have seen price cuts, and homes that once sold within 10 days are now averaging 44 days on market. At current mortgage rates near 7.1%, buyers need to shell out over $9,600 per month for a typical Irvine home, even with 20% down. With the area's median household income around $110,000, these prices are far out of reach for most local residents. Investors are also pulling back, with investor transactions down over 40% since 2021. Adding pressure are rising property taxes, HOA fees, and higher insurance premiums, especially for luxury townhomes and condos. Irvine's high price per square foot, well above $800, has led many would-be buyers to consider inland or out-of-state alternatives. Despite its many advantages, Irvine's market is showing signs of fatigue. If interest rates remain high and economic uncertainty lingers, prices could fall another 10% or more through 2025, especially in overbuilt luxury segments. Irvine is still desirable, but its housing market is overdue for a significant reset.